If you're looking for an effective way to multiply your money and secure your financial future, then you've come to the right place. Because in this video, I'll guide you through the 20 steps to multiply your money using the timeless principles of The Intelligent Investor by Benjamin Graham. Are you ready to be part of the 1% who are willing to change their lives? Then join me on this journey towards financial freedom. 1. Understand the basics of investing. Before diving into the world of investments, it's crucial to understand the basic fundamentals. This includes understanding concepts such as risk, return, and diversification. Imagine you're planning to invest in stocks for the first time. Without understanding the basics, you could end up making impulsive and risky decisions that could result in significant losses. By knowing the fundamentals of investing, you're better equipped to make informed decisions and minimize the risk of your investments. What is your current level of knowledge about the fundamentals of investing, and how can you improve it? I recommend dedicating time to educate yourself about the basic concepts of investing before making any decisions. This will help you build a solid foundation for your future investments. 2. Set clear and realistic goals. Before starting to invest, it's important to have clarity about your short and long-term financial goals. This will help you focus your efforts and make decisions consistent with your goals. Suppose your short-term financial goal is to save enough to buy a house in the next 5 years. Setting clear and realistic goals will help you develop an investment plan that brings you closer to that goal. Clear and realistic goals provide you with direction and motivation to keep going, even when you face challenges along the way. What are your short and long-term financial goals, and how do you plan to achieve them through investing? I suggest writing down your financial goals and reviewing them regularly to ensure you're on the right track. This will help you maintain the focus and discipline needed to achieve financial success. 3. Diversify your investment portfolio. Diversification is a key strategy for reducing the risk of your investment portfolio by investing in a variety of assets, such as stocks, bonds, real estate, among others. Suppose you have all your investments in stocks of a single company. If that company experiences a sudden market downturn, you could lose a large portion of your capital. However, by diversifying your portfolio by investing in different types of assets, you can mitigate the impact of any loss. Diversification protects you against market volatility and provides you with greater long-term financial stability. How can you diversify your investment portfolio to minimize risk and maximize return potential? I encourage you to research and consider different asset classes when building your investment portfolio. Don't put all your eggs in one basket, diversify and conquer. 4. Control your emotions. The financial market can be volatile and exciting, but it's important to remain calm and make decisions based on logic and analysis rather than emotions. Imagine the stock market experiences a sudden downturn, and you see the value of your investments significantly decrease. Instead of panicking and selling all your stocks, it's important to maintain composure and assess the situation rationally. Controlling your emotions allows you to make informed decisions and avoid impulsive reactions that could harm your long-term investments. How can you stay calm and control your emotions in situations of high market volatility? I recommend setting clear rules for yourself and following a well-defined investment plan. This will help you maintain discipline and avoid making decisions based on fear or greed. 5. Learn to analyze the intrinsic value of stocks. The intrinsic value of a stock is its real value, based on fundamentals such as cash flow, assets, and the company's growth potential. Suppose you're considering investing in a company and want to determine whether its stocks are overvalued or undervalued. By analyzing the intrinsic value of stocks, you can assess whether the current market price accurately reflects the true value of the company. Learning to analyze the intrinsic value of stocks helps you identify undervalued investment opportunities and avoid overvalued investments that could result in losses. What metrics and tools do you use to evaluate the intrinsic value of stocks before investing? I suggest familiarizing yourself with the principles of fundamental analysis and using tools such as financial ratios and discounted cash flow to evaluate the intrinsic value of stocks. This will help you make more informed and profitable decisions in the stock market. 6. Be patient and disciplined. Patience and discipline are key virtues in the world of investing. It's important to have a long-term perspective and resist the temptation to make impulsive changes to your investment portfolio. Imagine you've invested in a promising company, but its market value hasn't increased as expected in the short term. Instead of selling your stocks and looking for faster opportunities, it's important to maintain patience and allow your investments to grow over time. Patience and discipline help you avoid emotional decisions and stay on course towards your long-term financial goals. How can you cultivate patience and discipline in your investment decisions? I recommend establishing a solid investment plan and sticking to it even in times of market volatility. Keep your eyes on your long-term goals and don't let the emotions of the moment sway you. 7. Conduct research and due diligence. Research and due diligence are fundamental steps before making any investment. This involves thoroughly researching a company, its industry, and its growth potential before making an investment decision. Suppose you're considering investing in a new technology company. Before making any decision, it's important to research the company, its management team, its business model, and its competition to assess its long-term viability. Research and due diligence provide you with valuable information that helps you make informed decisions and minimize the risk of your investments. What steps do you take to conduct thorough research and due diligence before investing in a company or asset? I suggest using a variety of information sources, such as financial reports, market news, and expert analysis, to get a complete picture of the company or asset you're interested in. This will help you make more solid and profitable decisions in your investments. 8. Learn from your mistakes. Mistakes are inevitable in the world of investing, but the important thing is to learn from them and adjust your strategy accordingly. Each mistake is an opportunity for growth and improvement. I've also made mistakes in the past when investing in the stock market. But instead of lamenting my losses, I've used those experiences as valuable lessons that have helped me improve my approach and make more informed decisions in the future. Learning from your mistakes helps you develop a resilient mindset and avoid making the same mistakes over and over again. What are some mistakes you've made in your investments and what lessons have you learned from them? I encourage you to reflect on your past mistakes and identify the lessons you can learn from them. Use those lessons to improve your investment strategy and move towards your financial goals with confidence. 9. Maintain a margin of safety. The margin of safety is a key principle in investing that involves buying assets below their intrinsic value to protect against market volatility and potential losses. Suppose you're considering investing in stocks of a company, but the current market price seems overvalued compared to its intrinsic value. Instead of buying the stocks at that price, you would wait for the price to fall below its intrinsic value to gain a margin of safety. Maintaining a margin of safety provides you with an additional layer of protection against market fluctuations and allows you to invest more safely and profitably in the long term. How can you determine and maintain a margin of safety in your investments? I recommend establishing clear criteria to identify investment opportunities with an appropriate margin of safety. This will help you minimize risk and maximize return potential in your investments. 10. Be conscious of your costs. Costs associated with investing, such as commissions, fees, and taxes, can significantly affect your long-term returns. It's important to be aware of these costs and minimize them whenever possible. Imagine you're considering investing in a mutual fund that charges high management fees. Although the fund's performance may seem attractive, it's important to consider the associated commissions and fees that may reduce your long-term returns. Being conscious of your costs helps you maximize your net returns and ensure you're getting the best value for your money in your investments. What strategies do you use to minimize costs associated with your investments? I suggest regularly reviewing the costs associated with your investments and looking for ways to reduce them, such as opting for low-cost funds, negotiating fees with your broker, or using online investment platforms that offer lower commissions. Every dollar you save in costs is an additional dollar you can invest to increase your long-term wealth. 11. Don't be influenced by the crowd. In the world of investing, it's common for people to be influenced by the opinion and behavior of the crowd. However, it's important to make decisions based on your own analysis and judgment rather than blindly following the crowd. Imagine you're considering investing in a stock that has experienced a sudden price surge due to market speculation. Although it may be tempting to join the crowd and buy stocks, it's important to maintain objectivity and evaluate the situation for yourself before making a decision. Not being influenced by the crowd allows you to make more grounded decisions and avoid common market traps such as speculative bubbles. How can you maintain your independence and objectivity in your investment decisions, even when the crowd is acting irrationally? I recommend trusting your own analysis and judgment rather than blindly following market trends. Conduct your own research, evaluate the data objectively, and make informed decisions aligned with your long-term financial goals. 12. Adjust your strategy based on market conditions. The financial market is dynamic and constantly changing, so it's important to adjust your investment strategy according to market conditions and economic trends. During periods of market volatility, you may want to adopt a more conservative strategy and focus on capital preservation. On the other hand, during periods of economic growth, you may consider taking on slightly more risk and looking for more aggressive growth opportunities. Adjusting your strategy based on market conditions allows you to adapt to changes and seize opportunities that arise in different economic environments. How can you identify and adjust your investment strategy according to market conditions and economic trends? I suggest closely following news and economic events that may affect the financial market and being prepared to adjust your strategy accordingly. Maintain flexibility and adaptability to seize opportunities that arise in any economic environment. 13. Avoid speculative investments. Speculative investments are those that involve a high degree of risk and are based on the hope of making quick profits rather than solid fundamentals. Imagine you hear about a new cryptocurrency that promises extraordinary returns in a short time. Although it may be tempting to invest in it for quick gains, it's important to remember that speculative investments also carry a high risk of loss. Avoiding speculative investments protects you against market volatility and helps you maintain a more rational and grounded approach to your investment decisions. How can you distinguish between solid and speculative investments and avoid falling into investment traps? I recommend staying away from investments that seem too good to be true and focusing on assets with solid fundamentals and realistic long-term prospects. Prudence and caution are key to avoiding unnecessary losses in the market. 14. Maintain a mindset of continuous learning. The world of investing is constantly evolving, so it's important to maintain a mindset of continuous learning and be open to new ideas and strategies. I've also gone through times when I believed I had all the answers and didn't need to keep learning. However, I realized that the more I learned, the more I realized how much I had yet to learn. Maintaining a mindset of continuous learning has allowed me to constantly improve my approach and make more informed decisions in my investments. A mindset of continuous learning helps you stay updated on the latest trends and developments in the world of investing and adapt your strategy accordingly. What steps do you take to maintain a mindset of continuous learning in your investments? I suggest investing time in reading, research, and financial education to expand your knowledge and improve your understanding of the market. Never underestimate the power of continuous learning on your journey to financial freedom. 15. Be realistic in your return expectations. It's important to be realistic in your return expectations and not expect extraordinary profits in a short period of time. Successful investment requires patience, discipline, and a long-term approach. Imagine you're considering investing in the stock market and expect to double your money in just a few months. Although it's possible to achieve significant returns in the market, it's important to understand that it also carries a risk of loss and that short-term returns are difficult to predict accurately. Being realistic in your return expectations helps you avoid disappointments and make more grounded and consistent decisions aligned with your long-term financial goals. How can you set realistic return expectations and maintain a long-term perspective in your investments? I recommend setting realistic financial goals and focusing on steady growth of your wealth over time rather than seeking quick profits. Consistency and patience are key to long-term success in investing. 16. Build an emergency fund. An emergency fund is a financial cushion that provides you with security and peace of mind in case you face unexpected expenses or emergencies, such as job loss or medical expenses. Imagine you suddenly lose your job and find yourself without income for several months. An emergency fund would provide you with the necessary financial security to cover your basic expenses while you look for a new job. Building an emergency fund helps protect you against financial setbacks and maintain stability in your life, even in times of economic uncertainty. How much should you have in your emergency fund, and how can you start building it? I suggest having at least 3 to 6 months' worth of basic expenses covered in your emergency fund. Start by setting a realistic monthly savings goal and automating your contributions to be withdrawn automatically from your bank account each month. 17. Regularly rebalance your portfolio. Portfolio rebalancing is the process of adjusting the asset allocation in your portfolio to keep it in line with your investment goals and risk tolerance. Suppose you initially allocated 60% of your portfolio to stocks and 40% to bonds. Over time, the performance of stocks may increase faster than that of bonds, which may unbalance your portfolio. By rebalancing your portfolio, you would sell some of your stocks and buy more bonds to restore the original asset allocation. Regularly rebalancing your portfolio helps you maintain an appropriate level of diversification and control risk in your investments over time. How often should you rebalance your portfolio, and how can you do it effectively? I recommend reviewing your portfolio at least once a year and rebalancing it as needed to keep it in line with your investment goals. Consider using automated investment tools or consulting a financial advisor to assist you in this process. 18. Don't be swayed by market news. Market news can be volatile and exciting, but it's important not to be swayed by the noise and maintain an objective focus in your investment decisions. Imagine you hear news about an impending economic crisis that could affect the stock market. Instead of panicking and selling all your stocks, it's important to stay calm and evaluate the situation rationally before making any decisions. Not being swayed by market news helps you maintain composure and objectivity in your investment decisions, even in times of market volatility and uncertainty. How can you filter out market noise and maintain an objective focus in your investment decisions? I suggest staying informed about market news, but also conducting your own research and analysis before making significant investment decisions. Don't be swayed by market panic or euphoria, and always maintain a rational and grounded approach to your investments. 19. Seize long-term investment opportunities. Long-term investments offer the opportunity to achieve significant returns over time and harness the power of compound interest to increase your wealth. Imagine you invest in stocks of a solid, well-established company and hold onto those investments for several years or decades. Over time, those investments can generate significant returns as the company grows and prospers, allowing you to increase your long-term wealth. Seizing long-term investment opportunities allows you to build wealth steadily and sustainably over time, even amidst market volatility. What strategies can you use to identify and seize long-term investment opportunities? I recommend focusing on solid companies with a proven track record of long-term growth and profitability. Conduct your own research and look for companies with sustainable competitive advantages and a solid business model that can withstand the test of time. 20. Maintain a positive and persistent attitude. Maintaining a positive and persistent attitude is key to success in long-term investing. Although you'll face challenges and obstacles along the way, it's important to have faith in your abilities and keep moving forward with determination. I've also faced tough times in my investments, but I've always maintained a positive and persistent attitude. I firmly believe in the power of positive thinking and determination to overcome any obstacles that stand in my way to financial success. Maintaining a positive and persistent attitude helps you overcome challenges and stay on course towards your long-term financial goals, even in times of adversity. How can you cultivate and maintain a positive and persistent attitude in your investments? I suggest surrounding yourself with positive and motivated people who inspire and support you on your journey to financial freedom. Always maintain an open and flexible mindset, and remember that every challenge is an opportunity for growth and improvement. I hope this video has been helpful and provided you with some useful ideas and strategies for achieving your financial goals. Remember, successful investing requires education, patience, and discipline, but with the right approach and determination, you can achieve your financial goals and secure your economic future. And remember, this video is just the beginning of your journey to financial freedom. If you want to continue learning and improving your investment skills, I invite you to explore the next video displayed, where you'll find even more tips, strategies, and tools for success in the world of investing.